How did London's so-called dinosaur stock market just beat Wall Street at its own game? In 2025, while attention stayed locked on US tech giants, Britain's FTSE 100 quietly delivered its strongest year since 2009. The index surged more than 21%, outperforming Wall Street and surprising investors around the world. Returns stacked up, records were tested, and London, written off for years, suddenly stood ahead of the most powerful market on Earth. What drove this comeback? Who really benefited? And why did so many people miss it while it was happening? Because the real reason behind London's rise reveals something unsettling about where global markets may be headed next. For years, the story felt settled. Wall Street meant growth, speed, and innovation. London meant stability, tradition, and slow movement. The FTSE 100 was often mocked as outdated, filled with old companies from a different era. Meanwhile, Wall Street dominated headlines with technology, artificial intelligence, and record-breaking valuations. But markets do not reward stories. They reward numbers. By New Year's Eve 2025, the FTSE 100 had climbed 21.5%, its best annual gain since the aftermath of the global financial crisis in 2009. The wider UK all-share index was up nearly 20%. Wall Street had a strong year too, but not strong enough. The S&P 500 rose about 17%. The Nasdaq gained roughly 21%. Good returns, but still beaten by London. The reason was not luck. It was positioning. The UK market was already built for the kind of world investors suddenly found themselves navigating. Inflation refused to disappear. Interest rates stayed high. Geopolitical tension remained constant, and fear crept back into financial decisions. The FTSE 100 is heavy on energy, mining, defense, banking, and dividend-paying firms. Wall Street leans heavily on future growth and expensive technology bets. When conditions turned difficult, the market designed for stability and real assets held up best. London did not need to change, the world did. The biggest gains came from companies tied to things people run toward when confidence breaks. Precious metals led the charge. Fresnillo, a major gold and silver producer, became the top performer on the FTSE 100. Its shares soared an astonishing 450% in a single year. The driver was simple. Gold and silver prices surged as investors sought protection from inflation, currency weakness, and global conflict. Endeavour Mining, another precious metals producer, climbed 170%. These were not speculative moves. They reflected a global shift toward assets with long-standing value when trust in money systems begins to wobble. Then there was Airtel Africa. While many investors focused on slowing consumer demand in developed markets, this telecoms company operating across emerging economies surged 210%. Growth still mattered. It just showed up in places most people were not watching. Defense stocks added another powerful boost. As the Russia-Ukraine war continued and pressure mounted on NATO countries to raise military spending, defense budgets across Europe expanded. Companies positioned to supply that demand benefited immediately. Babcock International, which supports the Royal Navy's nuclear submarine fleet, jumped nearly 150%. Rolls-Royce, supplying engines for fighter jets, turbines, and propulsion systems for warships and military power systems, doubled in value. These were not hype-driven rallies. They were responses to a changing world order, yet the rally was not universal. More than one-fifth of FTSE 100 stocks finished the year lower. Some companies struggled badly. Distribution firm Bunzl and drinks giant Diageo each lost about a third of their value. Consumer pressure, cost challenges, and shifting demand weighed heavily. That contrast matters. The FTSE's rise was selective. Capital did not flood into everything. It moved with intent. Investors chased scarcity, income, and protection. They avoided businesses exposed to squeezed consumers and uncertain margins. At one point, the FTSE 100 nearly made history. On a single trading day, it reached an intraday high of 9,954 points. For the first time ever, the 10,000 mark came into view. The index fell short, but the message was clear. London was no longer lagging behind global peers. It was setting the pace. This all unfolded during a year that felt anything but calm. Global stocks rose about 21% in 2025, their strongest year since 2019, yet the path was filled with shocks. But if Wall Street is home to the biggest companies on Earth, how did London possibly outperform it? For years, the story felt settled. Wall Street meant growth, London meant stability. The US stock market was seen as fast, innovative, and tech-driven. The UK market was seen as slow, old, and boring. But markets do not reward stories. They reward numbers. Over the past year, UK stock indices quietly began beating US benchmarks on total returns. While Wall Street wrestled with high valuations and sharp swings, London benefited from something simple: lower expectations. UK stocks entered the year priced cheaply compared to US shares. Many British companies were trading at deep discounts, sometimes valued lower than their assets alone. When global investors looked for safety, yield, and value, London suddenly looked attractive again. Banks, energy firms, and commodity-linked companies dominate the UK market. These sectors thrive when inflation is sticky and interest rates stay higher for longer. Wall Street, packed with expensive growth stocks, struggled under the same conditions. In January, panic hit US markets when a Chinese chatbot called DeepSeek launched. The event wiped around $1 trillion from US technology stocks almost overnight. Investors described it as a Sputnik moment for artificial intelligence, a sudden reminder that dominance is never guaranteed. Then came April. On the 2nd of April, Donald Trump announced sweeping new tariffs on trading partners. By mid-April, the FTSE 100 had dropped 10%. Wall Street shook as well. But when the tariffs were paused, a recovery rally followed just as quickly. But beneath the rallies, another shift took place. The US dollar fell 9% in 2025, its worst year since 2017. Anxiety over the US economy and multiple interest rate cuts weakened confidence in the currency. Wall Street analysts now expect further losses over the next year. When currencies weaken, money looks for shelter. And in 2025, that shelter was not found in high-priced technology stocks. Gold told the story clearly. The metal surged 65% in 2025, its best performance since 1979. Investors rushed toward assets that could protect value during inflation, geopolitical tension, and currency debasement. The FTSE 100, filled with companies directly linked to commodities and real assets, benefited immediately. US tech stocks began to show cracks. Alphabet surged 65% as its Gemini artificial intelligence product gained market share, but others lagged badly. Meta rose just 13%. Amazon gained only 6%. Growth was no longer evenly distributed. The fear of an AI bubble grew louder. Across Europe, sentiment improved. The Pan-European Stoxx 600 index rose nearly 17%. Its best year since 2021. Investors started looking beyond the usual suspects. With the US dollar under pressure, fears of an AI bubble rising, and geopolitical turmoil unresolved, diversification suddenly mattered again. London fit that need perfectly. So, is London's lead over Wall Street the start of something bigger, or just a short-lived shift? But risks remain. UK growth is still slower than the US, political uncertainty never fully disappears, and if interest rates fall sharply, growth stocks could regain their edge. What matters most is balance. Investors who once ignored London completely are now reconsidering it. Even a small shift in global capital can move markets significantly. The key lesson is not that London will always beat Wall Street. It is that leadership changes when conditions change. Markets do not reward loyalty, they reward adaptation. And that leads directly to the final truth behind London's surprise win. London did not outperform Wall Street by becoming something new. It outperformed by staying exactly what it was while the world changed around it. If this changed how markets look, tap like so more people see it. Subscribe for clear breakdowns of global finance. And share this with someone who still thinks the FTSE belongs in the past.